So today's presentation that we're going to go over, and I am going to attempt to share my screen and get this all squared away. So I may need you guys' help on the, what part of my screen do you see? So let's see. So the presentation that we are looking at today is going to be one that I attended back in November for my designating organization. Trying to see if I can get this to go into. Okay, do you guys see what today's M&A market means for business value, but not like the back end, like the pretty side?
Yep.
Yep. Okay, cool. I want you guys to have the pretty stuff. You don't have to see my notes. So like I mentioned, we, in my designating organization, which is the National Association of Certified Valuators and Analysts, every year they do for us kind of a one-day boot camp to give us an economic update, make sure that we're up on our training, and teach us anything that's new or things that they want to make sure that we understand. So this presentation is actually I pulled most of the data you're going to see is actually from the economic update that we got. So I wanted to share this with you guys so you understand what we've been seeing from an economic perspective, how is it impacting value, but also how is it specifically impacting buyers and what we've seen in working in this due diligence space. So for those of you who don't know me, I don't recognize a lot of names, so I'm very excited that there's a lot of new folks here. As Andy mentioned, my name is Brittany Green. I am a certified valuation analyst. I co-own Green Appraisal with my dad, Bill Green. He's a certified fraud examiner, so we have all those certifications here on our staff. In addition to being a CVA, I am also a certified financial data analyst. My degree is in business analysis, so literally like top-down analysis. I'm an instructor for the Texas Association of Business Brokers. I'm with you guys for an hour. The business brokers get me for 4 hours. So I think you guys might be winning on this one. I also, in my free time, I had founded and was president and chairwoman of a nonprofit organization called Clear Lake Ladies Night Out. Basically, everything you should get from my background is that I don't stop and I pretty much don't sleep. I just got to keep going. So enough about me. Let's hop into our topic for the day. So one thing that we've been seeing with our buyers is kind of confused, right? Because you're getting kind of a tale of two cities. One is uncertainty because the economy seems to be slowing down. But on the flip side, businesses are still selling at strong prices. Like nobody's really kind of doing fire sales or something like that. We've had a few that we've seen that have kind of been in that situation, but it's not from an economic situation. It's been from a personal situation with the sellers. So businesses are still strong prices, so there is opportunity, but it also seems like there's been uncertainty and things are slowing down because of things we saw in the economy. So I can see why you guys are confused. Honestly, I was confused too. So this helps clear up some of the clouds, so hopefully it will do the same thing for you guys. Now, we're going to look at some of the economic indicators. Again, this was the same information that was provided to us back in November. Now, this is specifically looking at Q1 from 2024 through Q2 of 2025. Now, you may be asking me, well, what happened to Q3 and Q4 of 2025? I asked the same question whenever I attended this. The shutdown that we experienced that went like 40+ days apparently delayed the accumulation of the data for them to issue the reports for Q3 and Q4. So as of the date of whenever I took this back in November, those reports weren't ready. They may be ready now, or they may be rolling out here soon. I was able to source a little bit more additional information that was relevant to today, like a snapshot of 2025. So I was able to at least find something relevant. But all of this is crucial to us, correct? You know, because this is the information we have and it helps us make a decision. So the market analysis, again, looking at Q1 of 2024 to Q2 of 2025, our GDP, or gross domestic product, it increased in Q2 to like 3.8, but it was in the first quarter of 2025 at -0.6. Now, we did have a decrease from the Q2 to Q1, and then we did have the big spring up. And from what we've been told is that increase came from a decrease in imports. So we were utilizing things that were already in the US, increase in consumer spending, and we also see a decrease in investments in exports. Again, just trying to keep things, I guess, in the US was where we saw that huge jump in our gross domestic product. Now, what were some of the contributions to the change? Interestingly enough, finance and insurance was the one that kind of ran with it, followed by information technology, non-durable goods manufacturing, which we've heard a lot around manufacturing, where that's an area that's been having a lot of hype. I'm actually curious to see. I have a feeling we're going to start seeing more manufacturing businesses coming through our office as well, just because there's been so much movement in that industry as a whole. Professional, scientific, technical services, durable goods, real estate rental. The ones that didn't do as fair was the retail trade, federal government, unfortunately, utilities, educational services, and then state and local government also had some issues. So basically, if you're non-government, did fantastic. If you're government associated, not as great, which is interesting because we saw specifically with one of our clients who is an architect up in DC. He was telling me we had him on a rotation of doing an annual update every year. And starting last year, he was telling me, he was like, we're kind of getting hit with some slowdown. He was like, we have less and less people that are building houses and things like that. And most of his clientele were folks that were associated with the federal government as far as their jobs, contractors, et cetera, et cetera. And so we touched base with him pretty much every quarter last year. Every quarter he was telling me, he's like, it's not happening. They don't have the extra money, this, that, and the other, and then we touched base with him here in January, because it's officially February, y'all. January finally ended, which it feels like January lasted 365 days, not 31 days. And he told us, he's like, things are looking a little bit better, but he was like, he was trying to conserve cash, which I understand considering the year that he had. So it was interesting to see this information that came out and what we saw directly happening with a client who serviced this area. So it wasn't just necessarily federal government that had that issue. It was also those who provided services to folks in those areas as well, also were affected. So quarter to quarter change in prices. So your dark blue is the purchase price index for the GDP. The kind of grayish color that's right here, this one is the PCE, which is the personal consumer index. And then the dotted line is spending, excluding food and energy. I'm sure if we included everybody's DoorDash in here, probably would be even higher. But you can kind of see where the way I've kind of kept together. Spending stayed higher though, from a personal perspective, which for anybody who's looking at consumer-based businesses, which most of us do, or most of the ones that I've worked with you guys on, are consumer-based. We have had some commercial ones, which I do like too. And you'll see why we like some commercial work here in just a second. So let's talk inflation. I know everybody either went to the grocery store or their family has had to go to the grocery store and had to purchase eggs. And yeah, they were expensive, but everything seemed to have gotten expensive. So this chart that they gave to us looked at inflation rate for the last 10 years. So the inflation rate was 3% here in 2025. But if you go back and look at what happened like in 2015, we had hardly 1%, the good old days. And then we see where it kind of leveled out around 2%. So what was interesting is right in here, this like 2017, 2020 area, was actually when our industry, valuation, was using a 2% growth on discount rates to go from capitalization discount rates. We are at 2%. It was right around 2020, realizing, not knowing what was going to happen in 2021, but the indicators were there that things would rise. We started going to a 3%. Now, from 2021 to 2022, we saw like a 6.5% to 7% increase in inflation. We did see some valuation firms start adding growth rates at like 4% and 5%. The highest that we ever went was about 3.5%, mainly because we just didn't want to overreact to what was happening. And it only hung out there for about 2 years. I say only 2 years is a long time, but when we look at the economics of the situation, it did come back down, and we've hovered at an average of around 3%. So whenever you're seeing discount rates, or which I actually had this conversation with a client this morning about discount rates, what he was being told, he had a discount rate, He didn't have the growth incorporated. So we had this conversation this morning. So if you're seeing information looking at that, honestly, this should be right around 3%, maybe 3.5%, depending on where you're sourcing, just because we've seen a level amount for about 3 years in a row, and we don't see it continue going any higher into 2026. If anything, we may see numbers back like we saw in 2017, 2019, closer to 2%, like dipping under 3. But again, you'll most likely see your growth rates hovering around 3%. So information for you guys, for buyers, as you're doing your due diligence, as you're providing information to sellers, all the good fun stuff, this is probably what you're seeing, okay? So hopefully you stuck with me and did not fall asleep in the first 10 minutes of this. I know I kind of had to hang into it myself to find out, okay, all right, now we know the economics, but what's the next section? This is where, the dots really connected for me in our business, because what you saw in 2024 was a super roller coaster, right? It was up, it was down, and went like kind of all over the place. It felt like you were just, on a ride at an amusement park. And then in 2025, things stayed relatively steady, and we'll actually see where that is here, where you see the steadiness that happened. And quite honestly, I couldn't figure out what was going on until I actually saw this information. Then all of a sudden it was like, oh my gosh, this is what happened. So middle market for you guys, for middle market is typically considered, everybody has a different standard. Okay. So for what we're looking at here, middle market is like 10 to 50 million in revenue. Lower is anything like 10 million and under is called lower middle market. So we're going to look at middle market, which is 10 to 50, but we're also going to look at lower middle market. So when you look at this information, don't be scared by it, because it actually gives us some indicators for lower middle market as well. I know you guys kind of have a mix of different sizes deals that you guys go after. So why I wanted to provide you both sets of information. So middle market definition, I gave you guys a little bit of an idea, but what's interesting about middle market is that it makes up about 40% of the GDP. It is quite literally the backbone of the US economy. What's interesting is that with middle market businesses is that they're too big to be considered a small business, but they're also too small to be considered a big business. They're kind of like that happy medium, middle class family with the kids that are trying to go to college and you can't necessarily get scholarships because you make too much money, but also don't necessarily have enough money, so you kind of need the scholarships. That kind of middle spot there, that's what middle market is it's just kind of stuck kind of in the middle, and it really depends on which side of it that you're on as to what opportunities are available. So they have their own challenges, but they also have their own opportunities. And I'm sure some of you have run into this. When it comes to resources, middle market has access to resources, and even lower middle market have access to some really cool resources, because what we see, and I don't know how many of you guys do restaurants or restaurant groups, and I'm just now realizing the sun is hitting my camera, so I have like an angelic glow right now. I'm sorry if I'm kind of getting washed out a little bit, Andy, on the video thing, but I just realized that. So resources for middle market, lower middle market is you kind of get a little bit more creative. You're not locked into contracts with specific wholesalers or vendors. You can really kind of shop and play the field a little bit more. Labor has been more of a challenge for middle market and lower middle market. You have people who are absolutely trying to find labor and people to work for them, and you have other you have individuals that are trying to find jobs, but for some reason it feels like those who are trying to hire and those who are trying to get hired are having two separate conversations somehow, and they're just not coming together. So labor is a definite challenge for middle and lower market. Technology. One thing that we've seen most with this group, and I absolutely love it, is you guys are tech savvy. And the businesses that you're looking at are ones that are established, that kind of have dragged their feet getting into the technology realm. And you want to take them and drag them and put them into the, the 21st century here and really get them going. And I love that about this group. And it amazes me to listen to the technology options and solutions you have to some of the issues that we find with these sellers' businesses. So it is really an advantage. The technology is an advantage to this market and specifically to this group. Innovation kind of goes hand in hand with the technology. It's definitely an opportunity. But when you have companies who are been in business 30, 40 years, 20 years. They're kind of stuck in their ways, things like that. Little hard to get them to move forward as far as innovation. It truly is sometimes a little bit of a dog with a bone, right? You're trying to lead the horse to water, trying to get them to drink. It really does come through acquisition is how a lot of the innovation happens. Finally, regulation. In my experience with working with middle market and lower middle market companies, regulation is really industry specific. I have worked with some of you where regulations are not a problem. We don't run into any red tape. We have no issues. Everything is just sunshine and rainbows. We have other industries that we've worked with you guys on where regulation is just like, there's 7 different kinds of red tape. So I find like regulation is sometimes a challenge, rarely is it an opportunity. The opportunity is really where it just doesn't exist. So looking at some of the things that was, and again, this was something that they were educating us on in this class that I took, is things that were going into the new year from 2024 into 2025. I mean, quite honestly, some of this is still going into 2026. Of things that we thought that were going to happen and be, you know, resolved versus things that did happen after the election in 24, and what do we see with the new administration in 25. Going into the year, there was conflicts in the Middle East. We were hoping that those will be calmed down. Kind of are there now. From what keeping up with the current events, it seems like we still have some work to do, but at least maybe closer. Ukraine and Russia failed to resolve. Again, we're still trying to get that resolved here in 2026. Inflation continued, which we did see that in that chart. It had continued to go up. It has started to come down. What we can hope for is that it continues to come down. The national debt, it did keep climbing. We were kind of hoping that that might stall out a little bit and maybe, stop spending money like drunken sailors. And then recessionary threats persisted. So, there was a lot of people that were talking about we could potentially go into a recession. Fortunately, I don't think we did. There may have been some states or some areas that experienced that a little bit. But again, opportunity for you guys as buyers to kind of jump on the opportunity. What were things that actually happened? Several government policies got kind of turned on their head. We did experience tariffs and then inflation. What's been interesting about the tariffs was that we saw a small kind of blip increase in cost of goods sold for some businesses because they were still having to bring in resources or bring in materials from organizations that were experiencing tariffs. So we did see a kind of momentary increase in cost of goods sold. As we look at more companies here in 2026 to see the 2025 analysis, we'll know more as to how that happened. When you value companies in that year where they're experiencing it, we're looking at we're extrapolating what could happen for the rest of 2025. So that's why I said we saw kind of a blip of it. I am curious to see what we'll see here in 2026 looking backward. Now, talking about you guys as buyers, what are we seeing, right? Whenever we deal with buyers, we work with you guys, what are we seeing? What's been interesting is most buyers that we see are coming to the table with platform companies. Now, platform company, according to like our organization, how they explain it to us, is it's that first business to create a series, right? So it's the first acquisition to get this one building, going, all that good stuff, and then we're going to add other companies, whether it's 1 more, 2 more, 4 more. And ultimately, kind of the theory is to sell it to private equity whenever everything's done, or sell it out to a larger organization. I have a tomato sauce company. He's a prime platform company, but he's also a prime additional acquisition. And so what we're trying to do with them is get him situated to a point that he's attractive enough for people to come to the table. So how does kind of this circle of life for platform companies look like? What are we looking for in these businesses? So what am I looking for you in a buyer situation? We want to see strong financials. We want to see clean numbers. We want to see consistency. We want to see consistency in the growth. One thing that we have noticed, and I do a lot of education on this on the flip side for sellers, is we want to see that consistency and cleanup of their financial statements. I can't tell you how many sellers I have dealt with, and honestly, buyers, and I've seen what the sellers have done retroactively, is where they're like, okay, they decided in 2025, hey, I'm going to sell. So they start cleaning up all their financials, and you get them And 2026 looks pretty good, but 2025 is like, or even they started in 2024 and they've only behaved for 1 year. The indicators are there that it's going to be a positive change, but we don't have enough consistency of that change for them to pull down the premium that they're looking for. So that's where your buyer benefit comes into play with those who are kind of early on in the seller preparation stage. Is that's your opportunity to leverage. Is that if you can catch them 1 or 2 years into their planning or into their process, then you have some opportunity to kind of poke some holes in it. There was actually a gentleman that we worked with that was from this group that exact thing happened. His deal went from being like 800 and something thousand, it was what his offer was. By the time we got done with everything, the offer was actually closer to like 525,000 because we could see exactly what had happened and provided a list of questions. We punched some holes in it, and we ended up, he's helpful. I don't know if he actually closed the deal, but you're talking about like a $300,000 difference between the two. So strong financials is what we want to see. Leadership positioning. With some buyers, you may be looking at, hey, I actually want to change careers. I want to sit in the big chair. I want to actually run the company. But some of you guys that I've talked with through this group, you're kind of looking at this like, only being there maybe 1 or 2 days a week or a couple times a month, being more of an absentee owner and have a GM in place. Both of those are perfectly logical operations and they make sense. So based on what you're looking to do is what we have to see with the leadership positions that are in place. Now, how do we do that from a valuation standpoint is that we want to look at the revenue per employee to see, is the company actually performing? But we also look at, okay, the salaries, how is it broken down? What is owner compensation? Where are all of these things? So, really digging into that QOE, quality of earnings, due diligence, getting dirty, looking at all of these components. So once we have strong financials, we've got good leadership positions. Like I said, we want that predictable growth. We want it to be consistent. I mentioned to you guys, I was on a call with a client this morning that we're building up an oil and gas company for him right now. And we looked at some numbers last year. We're looking at some numbers this year. We actually tried to do an acquisition. Unfortunately, the seller backed out. How many of you guys experienced that one? Unfortunately, we experienced it there too. He went through a divorce, decided, okay, I lost my wife. He felt like he kind of lost his kids, so he didn't want to lose his business. You can understand where the personal piece comes from in that. But what we were talking about today for him with the growth on his business is we need to see predictable growth. Unfortunately, what we were looking at before versus what we're looking at now, I think we're looking at something that's more realistic now. But how do we figure out predictable growth? That may be the question that some of you are asking yourselves. It's like, okay, predictable growth is great, but how do we know? We have to compare the company to industry information. So once we can take the company, look at its competitors that are in the same arena that they operate in, same size. If we can get the same area, fantastic. I love that if we can get same region. But as long as we're looking at, we can get industry and size, then we can at least start figuring out, okay, where should this company be? And should it be predictable? Can we do these things? I have had companies come to me and tell me, oh yeah, no, I'm going to have 15% growth year over year for the next 3 years. All right, cool. So what are you doing to continue to grow the business? Oh, we're not doing anything different. Okay, well, your documentation says you guys are only growing at about 1.5 to 2%. So how do you think you're going to have a miraculous increase of 13%? So sometimes whenever everything sounds just, like it's going to be, sunshine and rainbows and we have all the marshmallows and all those good fun things, sometimes it's like, okay, did we get the name brand cereal? Do we have the Lucky Charms, or are we getting the store brand? Not that there's anything against the store brand. It tastes just as good, but is it as predictable in the taste that we get with the name brand? You guys follow? Hopefully that analogy made some sense. High quality assets. High quality assets is going to be looking at the people, the systems, the property, the customer relationships. But for me, I'm also going to be looking at the actual assets. I want to see liquidity assets. So I want to see what's current. Do we have cash? Do we have receivables? I want to look at what are the hard assets? Do we have inventory? Do we have equipment? What are these? What's our depreciation look like? I want to get all up in there. And especially with the accounts receivable, we've been having a ton of conversations with buyers around accounts receivable because of the fact that Number one, we have to figure out, the operating capital, but also we need to make sure that the company is actually collecting. And if they're not, it directly ties to the leadership position. So this can tie to this, and that if we have somebody, if their accounts receivable is at on average 65 days, they're saying that they invoice in 30. Well, do we have somebody in a good leadership position to actually go through and do those collections? I have a close friend, anybody who's talked to me about this, I have a close friend. She's a absolutely fantastic human being. I love her to pieces. Unfortunately, when I talk, I think I'm yelling at her because she's so quiet. And obviously, as you guys can tell, I'm not a quiet person. And so, but she does receivables for the company that she works for. And I told her one day, I was like, I absolutely adore you. You're a fantastic human. But how is it that you go to people and ask them for money? And I'm sure all of you have seen Rocky Balboa with the, and he's bouncing the thing. If he comes and asks you, what, are you going to pay your invoice? You're going to tell him yes. But whenever you have this, this church mouse of a little girl that I absolutely adore her, come to you and say, hey, you're going to pay your invoice. There's not as much up behind it, right? So, you want to make sure that if we are looking at some assets, those do tend to tie to leadership positions. I have had people ask me, well, how can you actually get HR decisions out of the numbers? The numbers tell us if we have people in the right places. So finally, consolidation. So with all those other pieces in place, the company becomes a consolidation. It's able to grow through add-on acquisitions. Can we scale it, more efficiently than our other competitors? So that's kind of how this whole thing comes together, and really what we've been trying to find, or what we've been seeing with some of the businesses. So let's move on. What else are strategic buyers doing? Or what are we seeing more of? And we're seeing more on the strategic buyers. Now, what is a strategic buyer? Strategic buyers are, I kind of wish there was like a chat function where you guys could tell me what industries you guys are already in, or I can see if I can figure out how to see it. If you would, tell me what industry background you have. Is your background in HVAC? Is it in restaurants? Is it, you're a CPA by trade, you're a whatever. I'm kind of curious to see what you guys' backgrounds are, because based on what your strategic background, or what your background is, a strategic acquisition is this. Okay, so Donald Consulting, I love that. So a strategic purchase for you would probably be like a CPA firm, a coaching firm, something like that, something that has those consulting-ish background, right? So Jarrett Turner, manufacturing. I love that. I'm so interested to see how your industry does. Like, as far as like you coming into from manufacturing into it, hopefully you're looking for a strategic purpose in manufacturing, and hopefully have time for Q&A at the end if I can get through this, and I want to hear more. You guys, I geek out over hearing about you guys' deals. Andy will tell you, I get way excited. So what we saw in strategic buyers, so those of you who were looking, Dr. Joel medical practice. Okay, well, with a term like Dr. Joel, I love it. So for you, it would be the advantage to strategic buyers is 1,000%. You guys can do a good turnaround on a business. Now, if Dr. Joel was trying to buy a manufacturing company, he would need something that is almost completely turnkey, because of the things that he knows, right? Or doesn't know. Like he can, if you get a cold like I had last week, he can fix me. But if I need to have this pin manufactured, maybe not so much, right? Now, Joel, I'm not picking you on purpose. It's just, that wouldn't be a strategic purchase for you. But the OBGYN practice that I just valued here locally to me at the end of last year might be a strategic purchase for you. You may not be an OBGYN, but you have medical background. So if he had issues, had a couple, you'd be able to turn it around. So what we saw with strategic buyers is the strategic buyers ended up making up more than half of the deal volume in 2024. I honestly think once we get all of the final numbers from 2025, we're going to see it be matching that, or even a little bit higher. Because with the public ones, they found the targets, right? Average deal was $90 million. Sounds like a lot of dollar figures to me. Private strategic, the volume was down, but it was still active. So we still saw strategic purchases happen, but maybe not as many as we saw in 2023. Now, privately owned businesses relied on valuations twice as much in 2023 and 2024 than they have historically. So what does all of this tell us? Number one, strategic buys, they're still happening. We love those. we are tending towards a business valuation. One thing that we did see, and I see this a lot in like the gas station industry, believe it or not, is that they just rely on their market multiples. What has it happened in the past, or, you know, and that's fine for the future. What we're seeing more of is they're relying less on that assumption and going more for the hard data, which obviously I like. So let's take a look at the next part of this. This was an interesting quote from Jay Hoffman. He's the head of JP Morgan's North American M&A division. And this is kind of what they saw from JP Morgan. Increasing optimism about the potential resolution of the tariff policy and its resulting macroeconomic impact has improved business decision makers' confidence. Consequently, M&A volumes and deal counts at the first half were robust and favorable conditions exist for acceleration in the second half. So what he was mentioning was 2025. So we saw favorable conditions. We wanted to see, did that continue? So this was the current chart that I was telling you guys that I went and sourced. So this is from the 2026 annual outlook. So they just published this in the last like month. And so where he was making this announcement was like here in like May and June. So we saw some indications, things look good. March was a good month. That's an expensive month for me too. I have 3 birthdays in the month of March. So not mine, but family. So yeah, March was an expensive month. But as we see, there was, yeah, it was pretty consistent, right? We didn't really have one woohoo, then down and woohoo and down like we did in 2024. Woohoo and down is an industrial term. Hopefully you guys are finally laughing at my jokes. Your volumes are off, so I just assume that you are humming along with my jokes here. So what we saw though is look at the deal counts here. We saw a dip in August, and then we saw a dip into the end of the year. Now, here's the super interesting thing. We saw the same thing happen in our business. We saw the same thing happen in a lot of businesses. From October, everything just kind of started sliding down. But why did confidence kind of decrease? Okay, is because right around in here is where we had that shutdown happen. We had a lot of things that got stalled out, and things that had to get redone, things like that. And so we were actually, more people were kind of in a cleanup phase than they were anything because of what we experienced. Now, here's the super interesting part is Martin Luther King Day is like middle of January. I promise you guys, that Wednesday after Martin Luther King Day through literally today, ringing off the hook, and everybody that I'm talking to experiencing the same thing. So it feels like we've kind of gotten past that hump of what we experienced there, and things are starting to open up. So if you're getting frustrated with like your deal search or things not happening or things not moving, the indicators that we're seeing right now, like live real time, I don't have a chart for it, everything seems to be grooving and cooking along finally. So Capstone Partners is a research and development group. And so they researched and they put out this thing or this information about buyers. Okay. You guys have remained highly valuation sensitive. So if the value doesn't come back where you think it should be, the valuation is a make or break. It is a decision maker for you guys, which fortunately I'm thankful I get to be part of that decision in that process with you guys. You're seeking recurring revenue. So what's interesting is that there's 2 books. Both of them were written by John Werlow. One of those is called Built to Sell. And through that book, he talks about how you kind of condense down into what you're really good at and you specialize at. As actually one of the vehicles of thought process that actually my dad and I followed to take ourselves from being a coaching firm that also offered valuation to being just a valuation firm about 3 years ago. So, but we ditched the recurring revenue for one-time revenue. But what we're seeing with you guys is that you as buyers, you're seeking that recurring revenue. If there is a company, we have a HVAC company that we're waiting on some information on right now, where they do new construction, but they also have maintenance contracts. So that recurring revenue, even if the recurring revenue only makes up 20 or 30%, that's a benefit, right? I have an IT company that's going to be coming up for sale in the next couple of years, and we need to specifically start increasing the amount of recurring revenue there because it's what you guys are looking for. So, pardon me, supply chain resilience. Unfortunately, supply chain issues have been around since 2020. I really wish that we could have left this in the past, but unfortunately, we haven't. But it is a key consideration of what we need to take a look at as part of our due diligence is that resilience, how consistently or how can we rely on getting that information? And also pricing power. So can you make that demand? So these are, if you haven't been looking for any of these things, this is basically across the board what buyers are looking for. And if this resonates with you, like, hey, that's what I've been looking for, you're on the right track. Good job. So buyer type activity. So we talked about strategic buyers versus financial buyers. Strategic buyers are buying ones that are similar to them. Financial buyers are, I just want to buy something. So those of you who are in the strategic situation make up like 60 to 75% of the total activity. The remainder is being done by financial buyers, where I just want to go buy something. So if you're this kind of, depending on which side of the fence you've been on, there you go. And if you're not quite sure what side of the fence you're on, this might help you make a decision which side. Not that it's good or bad, which way you want to go, it's what makes sense. So valuation growth for growth companies. Valuations remained elevated in Q2 of 2024, which is our indicator that investor optimism is there, right? What we love to see is that there's capital availability. I have talked to every single banker friend of mine that I possibly can. I do a lot of education and workshops with them, and they all keep telling me that they're lending. We're not seeing as many restrictions on which industries we're lending on. The only one that seems to be getting picked, well, I guess there's kind of two that keep getting picked on. Number one is restaurants, because they're restaurants. Like, unfortunately, I don't think that stigma is ever going to go away, unfortunately. The other one is oil and gas. So I mentioned my client that we were talking this morning. Oil and gas is always kind of it's a wildcat, right? Of trying to figure it out. So outside of those two, those are the only two industries that we still see hesitancy in capital being available, but it's pretty much open season, especially with the interest rates coming down the way they have. The cuts started at the end of 2024 and have continued. From what I'm hearing, again, from my banker friends, they're anticipating to have even more over the course of 2026, and we'll be okay with that. We're seeing market comps improve. Now, whenever we say market comps improving, what do we mean? We're finding ones that are close. We had kind of a run there for a little while where market comparables, like doing a market-based approach, wasn't necessarily there because we couldn't find comparable companies. So we were kind of having to default to leaning into more of an income or an asset-based approach. And then we just have a demand for high growth opportunities. You guys have probably seen this. If you see a high income producing or a consistent business or a high growth opportunity, you're probably jumping on it. And if you're not, go ahead. There was a term here of a pre-money valuation. It's not a common term that we see. Pre-money is pre-investment. So before getting any investor dollars or banking dollars, something like that, what's the value of it before that? So when you were looking at due diligence, we start doing that dig in, the work that I have done with some of you guys that are here or past folks here. What we do is we look at it before and then we take a look at it after, because we can actually run scenarios utilizing how much money you believe you're going to get, interest, all those good fun things. So there we go. So where are the deals happening? This was probably one of the most fascinating pieces that we had, which is the top industries. Believe it or not, technology services was the #1 growth company. So in 2024, 701 companies sold. In 2025, 883. So this is as of September 30th of 2025. So we still had a quarter to go. Technology services was #1. What's interesting is me personally, I haven't seen this high of a technology services like sale since like 2020 and 2021. So this is really interesting to me. Commercial services. Like I said, some of you guys have worked with you on like residential concepts like HVAC companies, plumbing, things like that are business to consumer. But the business to business, the commercial services, that's where we're seeing some of the movement. 477 deals in 2025 versus 406. Non-energy minerals, kind of a niche area, but did see an increase. And then industrial services, 248 versus 216. Now, those are the ones that did well. Which are the ones that kind of slipped? Unfortunately, finance. Finance and insurance, while we did a lot of, we also had less sales in our business. I guess we decided, hey, we're going to hang on to it. We're not going to sell it. Probably because we were doing better. Distribution services also saw a decrease. Producer manufacturing consumer of non-durables, and then consumer services in general. Those also has slipped. Now, you tie that to what we saw in the very beginning as far as the, what were the industries that were doing well as far as the increasing in sales. You might see some correlations between this list and that list. Now, deal size. So what we saw here is 10 million to like 100 million. So this whole area here, you can see this is the 2025 versus 2024. So what was the change? 50 to 100 million. So top end of middle market, they saw an increase, like 8.8%. 25 to 50 million, there was a dip. So like middle market, they saw a dip. 10 million to 25 million also saw a dip. But here's the kicker, where most of you guys are at, which is that 10 million and under, you guys stayed the same. Okay, you ran right underneath radar, let everybody else do whatever they're going to do up here. You guys stayed the same. So we still saw, but the other thing is that we still saw growth. So there was 11, almost 1,200 deals done in that 10 million and under. I really wish that we had more of the disclosed, like we had undisclosed ones. There were like 10,000 deals that were undisclosed. Obviously, those were private deals, so we didn't know. Honestly, because they are, more smaller deals, I'm guessing they're probably between 25 and under. I don't know for sure. They don't tell us. That's just my guess. But still, even if you just look at the ones we have, fantastic. We love to see this. So, activity by sector. Again, technology services, 883 deals versus 701. Commercial services, and again, you see down here where finance kind of had their dip. So there's all your differences as far as sector activity. This was absolutely fascinating. Like, this was a light bulb moment for me when I saw this chart the very first time. I was like, oh my goodness, that's where all the deals are at. So if you're not sure which industry you should be looking in, or you're like, I just want to buy something, you might want to take note of the top like 4 or 5 and see if there's something available there. Technology services, commercial services, because that seems to be where the deals are happening. That's where the grooving and the shaking is. So deal value. So while technology services was the #1, what is the deal value? Technology services were going on average, so this is like to the nearest million, 173 million. Not saying you guys need to go buy a $173 million technology company, but that was the average value. So there's still going to be smaller size deals in that sector because there's moving and shaking in it. Even the smaller businesses are going to be up for grabs. Finance value jumped considerably. While there were less deals, they went from being valued at like $50,000 or 50 million to 120. So you can kind of see where things are happening. Health technology, Dr. Joel. Here we saw deal difference kind of jump there. Utilities, industrial services, producer, manufacturer for manufacturing gentlemen, they did increase quite a little bit. So again, this was the second chart where I was like, oh my goodness, this is so cool. Just being able to see where things were at. Now, where did we see valuation drop? Government, miscellaneous, health services, Dr. Joel, you might be able to get yourself a deal. Commercial services, this kind of goes across the board as far as in that like HVAC, electrical, plumbing kind of thing. Looks like there's some opportunity here that the deals are actually coming down a little bit. We just have to help the owners understand that the deals are coming down a little bit. Consumer services, communications. So now, what are the factors that are currently driving the landscape? #1 is valuation. That is the driver behind where most people are making their decisions on, is what is the value of the company. #2 is what kind of rate can they get from the bank. #3 is just policies around it. And #4 is technology and innovation. Does the company have good tech, or does tech need to be there? We don't necessarily see technology go higher. Like, I've never seen somebody be like, oh, they don't have this technology, I'm not going to do it, because it's easy to incorporate. So it's kind of #4 on the list of reasons to buy the business. Valuation, fortunately, #1. For a while, it was kind of flipped, where it was rates was the higher number and valuation was #2. Fortunately, we are getting more value conscious now. So lower middle market real quick. What are you guys capitalizing on? Agility. So the company's ability to make changes and shifts and be able to pivot when you need to. Niche market opportunities. There are so many cool, very specialized businesses that are $10 million and under that absolutely fascinate me. One of my clients, if you've ever attended one of my past workshops or another workshop outside of this, One of my favorite companies to use is a soil consulting company. So niche. So this company actually gets called out before contractors do work on the property. He has to actually go out and test the soil. Only client I've ever had that has nuclear material listed as an expense. I love it. And then your ability to drive add-on transactions. I mean, we're not talking apple pie with that, but kind of the same concept, right? Being able to take the operation and do something to add it on to increase the ticket sale. So reoccurring revenue to a service contract on top of an HVAC. So advantages: pivoting quickly, like we mentioned, adapt to market changes. Because if you keep updates with your valuations, with your analysis, we can predict market changes, or at least see market changes, and be able to adapt to those on it quickly. Overcoming supply chain disruptions, because it's kind of funny. We had a restaurant chain that when we asked them about their vendors, and they're like, well, it's whoever I can go buy it from. I'm like, okay, well, what does that mean? They're like, I could be going to Costco, could be going to Sam's, I could be going to Kroger's, I could be going, to a restaurant supply. It truly is who has it the cheapest. So lower middle market, 10 million and under, a little bit easier to overcome some supply chain issues. And then evolve with consumer demands. So as you see, these two kind of go hand in hand. As the consumer is looking for something different, you can pivot quickly to be able to answer the call. So what are we looking for in due diligence in a business valuation? First thing is what are its strengths? I know this sounds a little SWOT analysis-y, but it's key. Okay, we want to see where is it doing well, where is its strengths, but we also want to look at where is the company weak at. We want to see operational models. We want to understand how it performs. And like I mentioned earlier, accounts receivable performance and process. How do we actually accomplish this? We do it through comparison reporting of looking at the company versus the industry, ranking it top 20 versus bottom 20. We rank it in liquidity, profitability, can it sell, can it borrow money, utilization of assets. And most recently, I think this is the first, workshop I've done since we've added this in, is we've also incorporated a financial audit into what we do as well. So literally looking at every line item on the P&L and balance sheet from an audit perspective. So that's what we want to take a look at to see where all of those things are, because quite honestly, that's where our opportunities to bring deal costs down lie. But it's also in helping you understand what are you walking into on the first day when you get the keys, and what are those things that you need to look at. So concluding with some optimism is why should we stay optimistic with our deals? I've talked to buyers that they're getting frustrated. I talked to a gentleman a couple weeks ago he's been looking for a deal for probably over a year. And he was like, Brittany, he's like, I think I'm going to go get a day job. And I mean, that like hurt my heart to hear him say that. So reasons to stay optimistic and looking for deals and that they are happening is that you want to find businesses that have stability and scalability. They do exist. And honestly, those are the ones that have done really good exit planning. They're usually at least 2 years in. They've gotten stable, they've been scaling, all of that, or they just have a good solid plan, operations, and they're growing. Interest rates are expected to continue being cut, so that's a positive. And with the improvement in the economic conditions, it's creating market confidence. So we're actually seeing more people, more sellers being more willing to let go than we kind of saw, because we saw some people like the gentleman I was referring to earlier, where we tried to do an acquisition in oil and gas, and it's like literally we got down to he was about to drive over to Louisiana, be in their office, I was going to be in my office, and we were going to be coordinating, getting documentation. Like we were there on this deal, and the guy backed out. So with these improving conditions, we should start seeing more confidence and less people backing out. There is still, a little bit of market risk, but, quite honestly, the thing we're seeing kill the deals is being unprepared. The deals are still happening. Capital is available. The banks are lending. The thing that we're seeing as the overrider on all of this is having a neutral opinion of value and looking at their performance. It's the number one reason buyers are buying is because the value makes sense. So, here is my contact information as far as, email, that's my office number, website, anything that you guys need. Be happy to answer any questions that you have. I will copy it and put it into the chat as well. But is anybody have any questions? Matt, you're in operations, diversified from retail to automotive. Oh, cool. Automotive service. Interesting. You know what? We've seen, you're probably, what was it? I've had 3 automotive companies come up for valuation. I'm actually waiting on documentation for one of them. It's just the seller's a little old school and slow. So I haven't been able to get all the documentation on the automotive, but I think I did 2 or 3. I did 2 last year. His would have been my 3rd. But he's been dragging on getting me documents. If you don't have specific questions about what we talked about today, if you just have a general question about your deal or what you're talking about or valuation or anything, let me know. I'm here to answer questions. I'm sorry, I'm trying to put my contact information in the chat.
And by the way, guys, if you need Brittany's contact information, feel free to Slack me or email me, and I'll be more than happy to provide it to you.
Yeah, don't smack Andy. It's fine. Okay. Anybody have a question? They have a deal they want to talk about. Don't be shy. It's okay. I don't bite. I don't yell.
Hey, Brittany, this is Delnata. How are you?
I'm good, Delnata. How are you? I love that name. It's so pretty.
Thank you so much. Could you talk a little bit more about how leadership positions, you said that leadership positions and how the the high quality assets, how those go together. Can you explain that a little bit more?
Sure. So what we specifically been seeing is that whenever we start digging into, so where we focus more on the assets, I mean, obviously we're going to look at kind of everything, right? But where we focus in on is the current assets. So things like its inventory, its receivables, cash accounts, but we're also going to look at equipment and things like that. So what some of the specific ratios we look at is like accounts receivable days, accounts inventory days, accounts payable days, even like those are like some cash gap opportunity ratios that we look at. And if we see that there's some kind of lag behind of that versus the industry, it's going to spark us asking the owner or the seller, whatever, he who is controlling or she who is controlling the business here, who do you have in this position? Like, what's causing this? What is your process? So we've seen it to where it's the wife of the owner that doesn't really have a whole lot of experience. That is the receivables person, where it doesn't necessarily have the wherewithal to be able to collect on a regular basis, or doesn't know what to do. Sometimes there is no process. Sometimes it's the person that's there just isn't in the right position. So that's where that leadership point comes into play. Same thing from inventory. If you don't have, if we see inventory days be crazy, like crazy high versus what the industry is showing us, we're going to want to find out who's the person that is actually in charge of doing those inventory controls. Is there a person doing inventory controls? Example for you, I have 2 brothers that own a performance engine repair company out of Nevada. And so whenever we were taking a look at all of their information, obviously they're the 2 primaries in the business, so they are the leadership, right? But they want to sell it. So we're going to have to look at, okay, for everything that you guys do, how many people would have to replace you? It's kind of like some of those corporate stories that you hear where, it's going to take 4 people just to replace 1. We have to understand, what does inventory controls look like? Who's going to actually do those purchases? Who actually tracks all of that? We're actually delayed on getting their valuation update done for this year, because when we did it last year, they didn't actually track their inventory. And then whenever we got into looking at the assets, they were like, well, we have all of this that's there. We just didn't want to pay taxes on it. And for me, I'm like, hey, I get it. I understand where you're coming from. But if you don't have it on the financial statements, I can't take it into consideration for the valuation. So it then becomes a discussion with them of tax advantages versus resale, of being able to sell the business. So to answer your question is that some of those components tell us, like, if we see some issues there, it leads us to asking, what is your process? Who are the people in charge of doing these things? Is the right person in the right place? Or if all of that is on the owner, then it becomes a conversation for the buyer of, okay, the owner's currently doing this. Are you going to want to do it? Or do we need to work out some kind of organizational plan or bring someone else in to take that over? Does that make sense?
Yes, yes. I
Okay,
understand.
cool. Matt had a question. So how does quality of earnings and valuation interact? So great question. For me, it's an all-inclusive deal. We end up looking at both. So quality of earnings tells us how is it performing. Ultimately, when I'm doing a calculation of value, which is, so my firm offers two different solutions. Full detail certified, so an actual M&A transaction, SBA loan, gift and estate tax, things like that. Full detail certified. Calculation of values, we look at one specific area. In the way that our program works is it's also a quality of earnings. We kind of just go deep dive into it. So the quality of earnings evaluation. So once we see what the quality of performance, what is it doing? Is it going to collect on those receivables? Are we going to be able to depend upon the activity of the business? Things like that. That is where that's going to have a direct impact on the value of the business. So what we see in the quality of the company is going to have a direct impact on the value. So do they directly, is I see something here, so it's going to do something here? Does that exactly happen? Kind of. It gives us, the quality of earnings gives us the indicators for the valuation. Because valuation truly is, it's science and it's art. So I have science and I have formulas, but we have art, and what are the components that are going to impact that value?
Got it. Thank you.
Oh, no problem. Yay. You guys are scared. Yeah, I feel like I can't see you. I'm the only person that has my camera on. Okay. Affordable housing, guys. I'm sorry I don't have your name. It just comes up with your company name. Thoughts on the outlook for buying lower middle market, less than 3 million, home service or senior home health care type businesses? I valued a lot of both of them. Okay. But what we were talking about with regulations, home health care, way more regulations than what we see in HVAC and plumbing. Now, they seem similar because they both have license requirements, but home health care services you can kind of get stuck over a barrel a little bit if you don't already have that nursing license, because there's some states, I believe Florida is one of them, where you have to, the owner or one of the equity partners has to have the nursing license for the home health care. Now, not to say that it's not a bad industry. It's a fantastic industry and it's a fast growing one, and there's a lot of them out there and there is a lot of value to them. But it has more regulation than what we see in home services. Does that help answer your question? Oh, but you were asking about outlook. HVAC companies are also doing well. We see the commercial HVAC companies, like the ones that are doing business to business versus to consumer. We see those going for higher rates, obviously because they do more, but we're seeing more consistency in their growth. Home services, though, across the board, they're always going to be a hot topic. Like, honestly, there is a high amount of turnover in them. Like every 5 to 10 years, it feels like there's one's being sold. But honestly, we're seeing the premiums come back. I have a roofing company that did, like, his came back at, and he wasn't really putting everything into it, right? Like he had room for improvement. And I think he did like $600,000 or $700,000. I think his value came back at like 425. But he was kind of trying to fire sale it too because he wanted to retire to Mexico, which I guess who doesn't? So if you can look for something that does home services and commercial on HVAC, plumbing, something like that, that's probably where I'd go if you can find it. Home health care services, a lot of growth. We like it, but again, certain regulations behind it. But if you want to talk through, if you have each of those as an option, you want to talk through, the specifics, I'd love to chat with you more about it, just to, because I don't charge for consultations, guys. So if you just have a question about your deal, call me. I'll talk you through whatever it is that I can from our perspective of like what documentation would you want to look at, what have we seen with this industry, stuff like that. I have not. Fortunately, it's rare when I get an industry I don't have experience in now. I actually have a quote out on a crop farm right now that we're doing some specifics on that. So we specialize in weird. So.
I have a question, Brittany.
Yes,
I'm the
sir.
one that has the manufacturing. So I have an industrial gasket manufacturing company,
Oh, cool.
mostly supporting the oil and gas industry. So it's been a little rough.
Ooh, okay. All right.
So
You're,
anyway,
you're fitting right in with the client I'm working with right now because it's support for oil and gas. He rents tools to oil and gas companies.
oh yeah.
So yeah, no, I'm down.
So this type of business usually, so I bought it from my dad. So a lot of
Okay.
them are owned by just older people. It's really kind of a niche.
Mhm.
Lots
Oh
of
yeah,
family
that's what,
businesses.
yeah.
So anyway, I'm partnering with another gentleman. He does the same exact thing that I do, and what we're trying to do is scale it. So
Okay.
him and I would kind of be the platform,
Sure.
but there's not many businesses like us for sale, and I've done a lot of cold outreach, and not a lot of people are willing to sell. So we're going to have to go outside of our
Okay.
what we do and so I'm trying to figure out like like a CNC shop or maybe a welding shop. So I'm trying to figure out what can we bolt
Something
on to
that's
our
similar.
businesses
Yeah.
where we don't
Okay.
get too far out.
I'll tell you something, like literally conversation I had this morning with the guy I'm working with right now. So what we're working on right now, because, okay, I also wrote his business plan because it's a lot of projections and assumptions and stuff like that. Something that not a lot of people know. Acquire knows because I've done this. So if you guys need help with business plans in addition to your due diligence stuff, call me. But with his, we wrote the business plan, but we wrote it for him to be a startup. And now we're needing to go back and make an adjustment because he's buying a certain division. And it's not even, division's kind of a little bit more specific than what it is he's buying a specific set of tools from a company to rent it back to them. So they're wanting to get rid of these because the maintenance cost and all that is too high. And it's not necessarily like they don't feel like they can scale that specific thing. So they're willing to sell it to him for like $2.5 million and then rent it back from him, and basically become his primary customer from that. So Jarrett, what you're talking about is that if somebody may not want to sell the whole company, but if there's a specific component of the business that is complementary to what you do, that maybe has high maintenance cost or maybe is a high cost thing, but you have a benefit or there's something that you can do to it, that it would make it attractive for them to sell that component to you and then potentially lease it back to them. That might be your best option for that specific piece. But I love what you're thinking as far as trying to find something that is complementary to you, that's still considered a strategic purchase, because you're basically expanding your service offering through acquisition. Does that make sense?
Yes, absolutely. Yeah.
So I get where you're at and I love it. I actually love to talk to you a little bit more and see if we know something, or even talk to my client, see if he knows of something that's coming up for grabs, just to see if maybe he knows somebody or something. But yeah, no, that I kind of love that direction of where your brain's at as far as trying to go find something that's complementary to expand. I would say you're on the right track. It's really going to come down to just finding it. But yeah, no, love it.
I appreciate it. And I've got a follow-on question as well.
Okay, sure.
Because if I'm going to partner up right now, and basically what we want to do, we want to scale and then exit to a PE group. So once we get to that point, and then of course this is going to be down the road, how do you combine everything together? Because we're probably going to end up, anything we acquire is going to
Say it's on
operate.
LLC. Yeah.
Correct. Yeah. Yeah.
So what ends up happening is we do an enterprise consolidation of the financials. So let's just say that you have XYZ LLC and you have LMNOP LLC, and then you have your your gasket company that you have right now. So let's just say you do 2 acquisitions, it's 3, but they're all independent LLCs. What happens is, and even if it's 2, right, you do this with 2, is that we go through and do a consolidation of the LLCs together. If the companies are making any kind of payments to each other or generating revenue off of each other, whatever it is, we do add backs and adjustments on whatever is common. So actually, this is kind of relevant to Dr. Joel, because I see this a lot in the healthcare industry, is you'll have the main practice and you have a management company. So the practice is paying a management fee to the management company to pay its bills, things like that. But it may pay rent, it may do certain things. So what happens is we have to take the expense off of this company and the income off of this company to zipper it together. So if there is any of those things that are happening between your two companies that you have, if one's paying the other money, we would need to take out that revenue, take out that expense, all that to zipper it all together. And then you do a valuation of the entire enterprise. I actually had a commercial services HVAC company in New York where we actually looked at doing that because he had a service-based business that was one LLC and one entity, and then he had a different like manufacturing things. Bye, Matt. Have a good day. A different like manufacturing LLC. So we looked at potentially zippering it together, but we were doing the valuation for gifting purposes, so we didn't necessarily have to do that on this one. But that's what you would happen with yours is we would just zipper it into one consolidation and do a valuation of the enterprise when you get to that point. Now, I'm going to tell you, don't wait until you're ready to sell it to zipper it and value it. Once you do the acquisition and you get a couple months under your belt, then I would do the consolidation. So do that consolidation, get the value of what it looks like then, because you're going to understand better where the entire enterprise needs to go if you have a look at the whole picture. So I would do entity one, entity two, and then, you know, the whole thing together, the whole enterprise together. So you know where are all your pieces moving, because if you do that, then you're setting yourself up for a better premium when it comes time to sell it.
Yeah, that's perfect. I appreciate that.
Absolutely. I love you guys. You guys come up with the best questions. It's fantastic. Andy, you have a fantastic group. I love these guys.
Thanks. Well, anyway,
And we ran over, so I'm sorry.
Not a problem. Well, Donata, do you have another question?
Oh, I do not. I'm sorry. I just didn't take myself off.
Sorry. Not a problem. Well, anyway, if you don't have any further questions to Brittany, feel free to just send me a message or send her an email or call her maybe if you have any further questions. And yeah, we really appreciate your time. This is a productive session today that we had. Thank you, Brittany, and thanks everyone. We'll see you back on Monday.
Appreciate y'all. Have a good day. Thank you.
Have a good day. Bye-bye.
Thank you.
Bye-bye.